What if I told you that every financial problem you have, overspending, not saving enough, forgetting to invest, constant money stress, has the same root cause? It is not a lack of discipline. It is that your financial system requires you to make good decisions every single day. With the same brain that is tired from work, making 200 other decisions, and being marketed to by companies that have spent billions of dollars figuring out how to get you to spend money. You will not win that fight with willpower. But here is what works. And I am going to give you the exact setup, specific banks, specific percentages, specific automation steps that I've seen repeated across every major personal finance success story. It is called the 3-account system. And once it is set up, which takes about 45 minutes, you never have to think about money management again. First, I need to explain why the thing most people do, budgeting, almost always fails. Budgeting is a willpower-based system. It requires you to actively track your spending, compare it to your limits, and make conscious decisions hundreds of times per month. Research on decision fatigue, the documented phenomenon where the quality of decisions gets worse the more decisions you make, tells us exactly why this fails. By the end of the day, your brain is depleted. The Friday afternoon impulse buy happens because your decision-making resources are exhausted. The solution is not more discipline. It is fewer decisions. If the money is never in your checking account in the first place, you cannot spend it. There is no decision to make. No willpower required. No guilt at the end of the month. That is the entire philosophy behind what I am about to show you. The system has 3 accounts. Only 3. And each one has one job. Account 1, your operating account. This is your everyday checking account. Bills, groceries, gas, dining out, everything flows through here. This is the only account you spend from. The rule for this account is simple: whatever is in here, you can spend guilt-free. Because everything that should be saved has already been removed before you can touch it. Account 2, your safety net. This is a high-yield savings account at a completely separate bank, not the same institution as your checking account. This creates what behavioral economists call friction. Making it slightly inconvenient to access this money means you won't touch it impulsively. This account has 2 sub-purposes. First, your emergency fund. 3 to 6 months of expenses, building up over time. Second, specific savings goals, vacation, car repair fund, future down payment. Account 3, your future. This is your investment account. 401k, Roth IRA, or a regular brokerage account. This is where your money multiplies while you sleep. Now, the specific banks matter because the interest rates matter. For your operating account, you can use whatever checking account you currently have, as long as it has no monthly fees and you can set up automatic transfers. Most people use Chase, Bank of America, or Wells Fargo here. They're fine for this purpose. For your safety net, this needs to be a high-yield savings account. In 2026, the best options are paying between 4.5% and 5.1% APY. That is 500 times more than what traditional banks pay. On $10,000 over 5 years, the difference between 0.01% and 4.85% is approximately $2,700 in interest. That is not life-changing, but it is completely free money for doing nothing differently. I'll link the current best options in the description. These change as rates move, so check there for the most current rates. For your future account, if you have a 401k with an employer match, that is your first priority. Every dollar of match is an instant 50 to 100% return. After capturing the full match, a Roth IRA is next. $7,000 annual limit in 2026, tax-free growth forever. After that, back to the 401k, then a regular brokerage. Here is the allocation framework. These are starting points, adjust for your situation. For someone with no emergency fund yet, starting from 0. 50 to 60% of take-home to operating, bills plus living expenses. 20 to 25% to safety net, building emergency fund first. 15 to 20% to future investing. Once you have 3 to 6 months of expenses saved. 50 to 60% to operating. 10% to safety net, ongoing goals. 30 to 35% to future, ramp up investing. Real example, take home $4,500 per month. $2,600 to operating, 58%. $500 to safety net, 11%. $1,400 to future, 31%. That 31% savings rate, invested consistently for 25 years at historical returns, produces approximately $2.1 million. This is where people stall, the actual setup. I'm going to walk you through it step by step. Step 1. Set up your high-yield savings account. Takes 10 minutes online. Have your social security number and a checking account ready to fund the opening deposit. Most requires $0 to $100 to open. Step 2. Link your new savings account to your checking account. This happens inside the savings account portal. Find external accounts or link a bank. Enter your checking account routing and account numbers. Takes 1 to 3 business days to verify. Step 3. Set up an automatic transfer in your savings account. Log in, find scheduled transfers or automatic transfers. Set the amount, based on your allocation. Set the date, the day after your paycheck hits. Step 4. Set up or increase your 401k contribution percentage through your HR portal. If you have a Roth IRA, set up automatic contributions monthly. Total time, 45 minutes. One time. Done. I want to address the objection I know you're thinking right now. What about unexpected expenses? This system actually handles that better than budgeting does. Because you are building an emergency fund in account 2 specifically for this. When the car breaks down, and you transfer from safety net to operating, cover the expense, and then rebuild the safety net over the next few months. The key is that the emergency doesn't derail your investing. It doesn't blow up your budget. It just temporarily slows your safety net rebuilding. The system bends. It doesn't break. Here is what changes when this system is running. You stop thinking about money constantly. You stop feeling guilty about every purchase. You stop arguing about budgets. You stop wondering if you saved enough this month. Because you already did. On payday. Automatically. The people who build genuine wealth are not more disciplined than you. They have just removed discipline from the equation entirely. Next video, once this system is running, how do you actually invest the money in account 3, what do you buy, in what proportions, and why? That video is right here. See you there.